I just don't really see any real resistance to the price of gold going higher. You're in new territory. You're at record highs. We've just broken out of a 10, 12-year resistance. We should just keep going up and up and up. And the gold stocks haven't even priced any of this in. I think they will do it violently. There will be a very rapid readjustment of price. And then, you'll still be able to buy them. I've never had a bigger position in gold mining stocks than the one I have right now. And I'm extremely comfortable with it. I've been bullish on gold stocks before. Obviously, you've been following me. You know that. I don't know that I've ever been as bullish as I am now. I mean, I've been bullish, right? So it's not like I wasn't. And, I should have sold some of these stocks and taken profits. I didn't.
The US GDP report released on Thursday showed a sharp deceleration in economic growth and stubborn inflation, which in turn is seen as a key factor lending support to the gold price. For the past 2 decades, gold stocks have underperformed gold on the upside and suffered more significant declines on the downside, disappointing investors' expectations. However, the latest earnings season for gold stocks is promising, with companies expected to report their most profitable quarter in years, fueled by higher gold prices. Additionally, most miners have forecasted cost containment measures, which should further boost earnings alongside gold's surge. Renowned American stockbroker and financial commentator Peter Schiff remains steadfast in his optimism for gold, noting its resilience despite recent market volatility. Despite the news leading to reduced rate cut expectations and a decline in the dollar's value, Schiff predicts a significant upward movement for gold towards $2,400. This bullish sentiment is supported by the positive response from miners to rising gold prices as the precious metal gains traction, climbing 0.7% to $2,330 per ounce, buoyed by escalating stagflationary worries triggered by the latest gross domestic product report. Regarding market dynamics, Peter highlights the resilience shown by mining stocks, particularly citing Newmont Mining's impressive earnings beat, which led to a substantial increase in its stock price. Newmont has been on track to achieve its best-performing session since April 2020, when the mining giant rallied following a major volatility event due to the COVID-19 pandemic. Newmont Corporation participated in the resurgence of precious metals on Thursday, when they reported that gold sales and production rose more than 30% year-over-year in the first quarter, and the stock rallied. From a technical perspective, Peter questions Wall Street analysts' downgrade of Newmont Mining at a low point, only to see it soar afterward. Now, we present the clips of Peter Schiff's insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The interesting thing was, even though this bad news came out on stagflation, which of course immediately meant that the markets dialed back their expectations for rate cuts, the dollar sold off yesterday pretty much across the board, and gold was up a bit, although gold was down on the week. I mean, gold was down almost 2%. It was down about 4% on the week because we had a big drop on Monday. Gold was down like $60. I think the reason that gold got clobbered on Monday after closing Friday at the highest close ever for a week was that the weekend went by and there was no hostilities in the Middle East. And I think because nothing happened, some people who might have bought gold as an insurance policy in case something happened, they sold. We had a sharp correction and gold dumped. I think we shook out a lot of weak short-term speculators, but 2,300 held pretty firm. And I think 2,300 is the new 2,000. I think that's really where the support is right now. The resistance is just above 2,400. So I think we're in a narrow range until we take out the highs, which I don't think the highs are going to last much longer. And I think a good indication of that is the relative strength that we had in the mining stocks. We finally had mining stocks going up with gold going down. And that's generally a good sign when gold is corrected, which we had the whole correction in one day, but it, sharp. But when you see gold going down, but the gold stock's not, it means that the selling in the miners is kind of washed out. And now they're actually starting to buy the miners. And one of the big reasons that these mining stocks are going way up is Newmont Mining came out with an earnings beat yesterday. And at one point during the day, Newmont was up about 15%. One of the biggest moves I've seen, certainly that I can remember seeing, in Newmont Mining, which is the largest gold company there is, and it was up 15%. It didn't even hit a new 52-week high. I mean, that's how much the stock got beaten up this year. In fact, we're still a long way. The 52-week high in Newmont is over $50, and we're at 42. So despite that big move, but more significantly, we're up at that about 50% from where Newmont was in February, a couple months ago, 2 months ago. And on this podcast, I talked about that. That's when Newmont got downgraded from a buy to a hold, which is the Wall Street, slang for sell, right? If an analyst downgrades something to a hold, he means sell it. They just don't like to say. I mean, sell is a 4-letter word on Wall Street. They rarely mention it, right? But they will tell you to hold. You're supposed to read between the lines. And so this guy was telling you, this is an analyst, right? This is his job to analyze gold stocks. And so he watches Newmont Mining go way down, from $50 to below $30 or 30, about 30. And then he decides to say, you know what? I don't think you should buy it anymore. Let's just sell it. And his rationale for recommending selling on the low was that he didn't see much upside for gold, which was at around 2000. And I was on this podcast saying, this is ridiculous. I bought Newmont for my own account that day, and I bought it for my own account the next couple of days because it kept going down a little bit, and I just kept buying more. I thought this was a gift, and now here's the stock 50% higher, than it was on that day. And I remember when I read the report, the guy said that if gold went up and their outlook changed, that they would revisit this and maybe put it back on a buy. And my point was, well, what's the point of that? Because by the time gold goes up and you raise it back to a buy, the price is going to be a lot higher. And of course, the price is a lot higher, and they still haven't put a buy on it. So how much higher is it going to go before this analyst tells people who sold it at 30 to buy it back? Maybe 60, 70, I don't know. But why does this guy even have a job? I mean, all he does is analyze gold stocks, and he does this bad a job. But this is generally what happens. And I said at the time, this was a great sign that Wall Street is throwing in the towel on the biggest mining company there is. And now it's had this huge gain. In fact, there's not that many stocks that have done as well. Forget about gold stocks. There's not many stocks in the S&P or the NASDAQ that have done as well as Newmont since Wall Street put a sell on it.
During the interview, Peter Schiff delved into the intricacies of inflation targets while expressing skepticism about the Federal Reserve's 2% inflation target. Concurrently, he suggested it was introduced to justify expansionary measures like QE and low interest rates when inflation fell below 2%. Friday's report from the government showed that prices rose 0.3% from February to March, the same as in the previous month. It was the third straight month that the index has run at a pace faster than is consistent with the Fed's 2% inflation target. Measured from a year earlier, prices were up 2.7% in March, from a 2.5% annual rise in February. Meanwhile, gold has historically thrived as a scarce, durable asset with intrinsic value, and its price rise amid inflation isn't solely due to its safe haven status. In Peter's view, sticking to the 2% target could spell trouble if inflation surpasses it, creating a mismatch between policymakers' goals and economic reality. This discrepancy could pave a challenging path ahead. Let's get back to the interview.
Now, also on the stagflation, we got the PCE, which was supposed to be up 2.6 on the year over year, was up 2.7%. So again, headed further away from the Fed's 2% goal. The prior month, it was at 2.5. So if you're going from 2.5 to 2.7, how can the Fed have any confidence that we're drifting down to 2% when we're actually rising in the opposite direction? And the core year over year was up 2.8, which was better than the 2.7 or higher than what they expected, but it matched the 2.8 from the prior month. But 2.8 is a hell of a lot closer to 3 than it is to 2. Now, the month-over-month numbers were in line, up 0.3 on both the headline and the core. The reason the numbers were hotter was because of the revisions to the earlier months, but still going in the wrong direction. But one thing that's interesting, and I actually posed this question on X earlier today, the 2% inflation target wasn't invented by the Fed until inflation was below 2%. So for years, during the 1960s and 1970s and 1980s and 1990s and even the 2000s up until '08, right? The Fed never announced that it had a 2% inflation target. Well, because inflation was above 2%. So they didn't want to have a 2% target when inflation was 3 or 4 because they didn't want to do anything to actually lower the rate. All of a sudden, inflation is like 1.5, 1.1, and out of nowhere, all of a sudden the Fed says our target is 2%. Why? Nobody asks, right? How did this happen? Congress never called the Fed and said, hey, we want you to target 2%. All of a sudden, the Fed just invented this 2% target. The only reason they did that was because inflation was lower than 2%. When it was above 2%, they never wanted that target. It was only when they were below. Now, why? It was a convenient excuse to create inflation because they wanted to print money. They wanted to stimulate the economy with QE and artificially low interest rates. So they made up this pretense that, well, we need 2% inflation. That's our target. And God damn it, we're only at 1%. That's really terrible. This is really dangerous territory here. We're skating close to the edge, because we could slip into the dreaded deflation when we're this close to, deflation here. So it was only because inflation was below 2% that they had a target. So now we're back above 2% inflation, and now they're kind of stuck with that target, right? It's like an albatross around their necks. They're never going to get it back down there because they never were able to get it back down there. They never even had the guts to try. And so now they've just kind of painted themselves in a box. Now, maybe at some point, they're hoping people will forget about this 2% inflation target because they're not going to hit it, right? It was only the target when they were below it. And it wasn't really a target. It was an excuse. They wanted to create more inflation. And so they used this phony 2% target as a rationale for doing it. But again, I pointed out on this podcast where that came from. It came from the Central Bank of New Zealand, the Reserve Bank, which had a 2% ceiling. It wasn't a target. And it wasn't like, try to get as close to the ceiling as possible without going over. Like it wasn't the Price is Right. The reason there was a ceiling, it was like try to stay as far away from it as possible. So if inflation was 1, they didn't try to get closer to 2. They were glad they were at 1 and not 1.5, right? So the lower the better. The idea was just don't let it get as high as 2. Even if it was a negative number, that was okay. So we took that and we turned it into this ridiculous target to justify an inflationary policy. And now we are paying the consequences of that inflationary policy.
FX Empire reports that the monthly gold chart has validated a significant breakout, fueling speculation that prices could reach $3,000 by 2024. Looking ahead, projections indicate that by 2030, gold prices may surpass $8,000. Given what we've discussed, what do you reckon about the future of gold and gold mining stocks? Are you feeling bullish, cautious, or somewhere in between? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.